Welcome to this explainer. If you're watching this, you're a focused learner ready to cut through the noise and get straight to what actually works in the markets. We're diving deep into trading psychology and risk management today. And look, here's the absolute truth. Long-term success in trading, it's really not about finding some magical secret strategy. It is entirely about building ironclad habits that protect you from yourself.
So why do 90% of traders fail? It's the multi-million-dollar question, right? We've all felt that pit in our stomach watching a balance drain down to zero. Most beginners just convince themselves they haven't found the holy grail strategy yet. So they hop from indicator to indicator, blaming the market. But the data and the top professionals tell a completely different story. The strategy is almost never the problem.
Okay, let's dive into this. Here's our roadmap for today. We'll start with the retail trading trap, move into surviving first and profiting second, talk about mastering your emotions, break down a professional trading routine, and then wrap up with the one ultimate rule.
All right, part one, the retail trading trap and how we actually escape the cycle of inconsistency.
Look at the stark contrast and pure mindset here. Retail traders honestly act a lot like gamblers. They chase their losses, they crave daily action, and they buy in purely on FOMO, fear of missing out. But professional traders, they're practically playing a completely different game. Their number one job is protecting capital. They stay incredibly patient and they think long-term. Trading shouldn't be a thrilling roller coaster. The real goal is consistency. And to be perfectly honest, true consistency is kind of boring. If you want excitement, you're gambling. If you want profitability, you've got to embrace the boring.
Which brings us to part two, survive first, profit second. This is the defensive foundation of trading.
So what does survival actually look like in practice? Well, check out the math. Professional traders risk a maximum of 0.5% to 1% of their total account on any single trade, period. So if you're running a $5,000 account, your max risk is just $25 to $50. On a $10,000 account, it's $50 to $100. This is a totally non-negotiable boundary. I see beginners scaling up their lot sizes all the time just because they feel confident about a setup. But guess what? The market does not care about your confidence. Sticking to this strict percentage rule mathematically guarantees that a random streak of bad luck never completely takes you out of the game.
And that brings us right into another foundational number, the 1 to 2 minimum risk to reward ratio. If you're risking $50, your target absolutely must be $100 or more. Why? Because with a 1 to 2 ratio, you can literally lose multiple trades, hit a win rate under 50%, and still mathematically grow your account. Your edge isn't about predicting the future perfectly every single time. It's just making sure your winners are always significantly bigger than your losers.
But to maintain that math, you have to follow strict pre-entry rules. Before your mouse even hovers over buy or sell, you need to know your exact entry point. You need a fixed stop loss, and you need established take-profit targets. And out of all of these, the absolute most critical rule is this: never, ever move your stop loss emotionally once the trade is live. If you widen that stop because you're praying for a reversal, you're no longer trading a proven system. You're just hoping. And hope is a terrible trading strategy.
I really want you to think about this concept. Your stop loss is a seatbelt. You don't put it on because you expect to crash, right? You put it on so that if you do, you survive to drive again. We really need to reframe how we view taking a loss. A triggered stop loss is not a failure. It's just a vital business expense. It's your survival mechanism kicking in to save you from a catastrophic blowout. Traders who skip the seatbelt aren't braver. They're just one bad market spike away from losing the whole shebang.
To add an extra layer of armor, you must use a strict daily drawdown rule. The easiest, most effective one: stop trading after 2 losses. Period. Close the laptop, walk away. The urge to revenge trade to win back what you just lost is a massive psychological trap. In fact, failing to just stop after a couple of losses is exactly why so many skilled traders bomb their prop firm challenges. They have the technical skill, sure, but they completely lack an off switch.
And that segues perfectly into part 3, mastering your emotions, winning the internal battle.
Look, the math of risk management is pretty straightforward, but the human mind, incredibly tricky. Take a look at these toxic emotional triggers. We're talking forcing trades when the market is choppy, taking boredom trades just because you're sitting at your desk and want to click a button, revenge trading to get your money back, and those classic FOMO entries where you're chasing a candle that's already taken off. Your job as a trader is not to trade a lot. Let me say that again. Your job is not to trade a lot. Your job is to wait patiently for clean opportunities, because excitement almost always leads to execution errors.
This hits on a pretty heavy truth. Losses have never actually been the scariest thing. What's truly dangerous is the exact moment you lose control. A standard, planned losing trade won't destroy you. What destroys you is the moment you abandon your discipline. Just one single instance of breaking your own rules, nudging that stop loss, doubling your lot size out of frustration, can wipe out months of patient, methodical work. That loss of control is the real enemy.
So, how do we actually fix this? Well, we have to completely detach our emotions from the money. As a beginner, it's so easy to just stare at that P&L column. But to evolve, you need to ask yourself one simple question when a trade closes. Did I follow my system? Not did I win? A setup can be absolutely flawless and still fail. That's just market probability. If you followed your rules to the letter and it hit your stop loss, that's actually a successful execution. You have to detach from the monetary outcome and obsess over the quality of your execution.
All right, part 4, the professional trading routine and how to systemize your success.
Discipline isn't just about sheer willpower. Honestly, willpower gets drained as the day goes on. Real discipline is about having a rigid, unbreakable routine that essentially does the thinking for you. Step 1. Check the higher time frame trend so you know the overall direction. Step 2. Mark your key levels: supply, demand, support, or resistance. Step 3. Wait for specific confirmation. Don't jump the gun. And step 4. Define your exact risk before entering. Using this kind of systematic checklist drastically shrinks the room for emotional, dopamine-driven decisions. It turns hope into a repeatable process.
And what you do after the trade is just as crucial. You've got to journal every single trade. Write down exactly why you entered. Note your emotions. Were you anxious, greedy, impatient? Document any mistakes, and always include screenshots of your charts. Journaling is the absolute engine of continuous improvement. When you review it, you'll start spotting these hidden personal patterns. You might realize, wow, I get super overconfident here, or I always close winning trades early because I'm scared. You can't fix a psychological leak if you aren't tracking it.
Finally, let's look at part 5, the one ultimate rule. This is your psychological anchor.
It really all boils down to this. Never let one trade emotionally affect the next. If you just took a loss, the next trade does not owe you a single thing. And if you just hit a massive winning streak, you are not suddenly invincible. You have to treat every single setup as an entirely independent event. Adopting this exact mindset, treating every trade in a vacuum, is exactly what saves prop firm accounts and separates the true professionals from the gamblers. Which leaves us with one final vital question. Are you going to spend your time trying to master the market, or will you finally commit to mastering yourself? Look, the market is always going to be chaotic, unpredictable, and completely out of your control. But your risk management, your routine, and your emotional discipline, those are 100% in your hands. Master risk management and psychology, build the habits that protect you from yourself, and the consistency you're looking for will absolutely follow. Thanks for joining me on this explainer. Keep your risk tight, stay disciplined, and I'll catch you in the next one.